Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll sprinkle in my financial opinions as we go through it. It's going to be wealth related, commodity related, and or financial topics that I'll be covering in this uh, social media Twitter. So let's dive in. Let's take a look and see what's going on. If you want to follow me at finding_finance, and if you want to join our community, we do have a discount going on, finding-value.com. I just released a training session that we did Thursday. It is released on the website, and you can see it if you join. You can see all previous question and answer sessions and midweek updates all the way back to 2022 to see the companies that I like and what we've been doing. The RevCap, he says, let's get this convo going in a way that makes a difference. Politicians that matter talking about housing supply. Lael Brainerd is also focused on this. More land permitting to get finished lots prepared seems like the easiest avenue. So it looks like politicians, Federal Reserve, whomever, is getting involved in the housing market. They're going to try to solve the supply problem. If they solve the supply problem, it's going to be inflationary because that's where loaning comes into existence. And they won't be fighting inflation, they'll be creating it. So that is part of the thesis, it's part of the cycle. And this will be very good for home builders and also very good for anything that's commodity related because it's going to be credit expansion in the system. This is right up our alley, guys. And if politicians want to help us make money in commodities, that's all the better, guys. Summer driving season in December, very weak, right? Question mark. Implied gasoline demand 9.17 million barrels per day. I thought demand was supposed to drop, guys, but we've got summer driving season in December in terms of demand. Quite interesting. Elizabeth Warren, really, we've got 40 years ago, a typical single family home in greater Boston sold for $79,400, about 4.5 times a Boston public school teacher's salary. Today, that home would be nearly 11 times what that teacher makes now. We must bring down costs, which means we need more supply. Plain old Econ 101. I hope she understands that the majority of the increase in the cost is inflation. If you were to price home prices on a long term, let's do this. Let's see if I can do this. So here is 1 second, guys. Let me yank this up. So we've got, what is it? Case-Shiller home price index. There's that. And then I think what we can compare this to is the M2 money supply times M2 velocity. I think that this is basically a very close relationship between your GDP growth or M2 money supply times velocity and the house prices cycle about the M2 times velocity over time. And you can see that we are a little bit above it. So, and the thing that pushes it above or below is if you're in an expansion phase of real estate. So we went into an expansion phase kind of 2019, 2020, where this came on up, and we're sitting above that. So ultimately, the price of the home is determined by your M2 money supply times your velocity. It's really how much money's in the system. If you take money out of the system, that's the only way that you can really reduce the price of homes any substantial amount. If money comes into the system, you're going to get inflation. Inflation's going to drive your break-even points of the home build higher, or you have to build a lot smaller homes for people to afford. I don't know any way around it, but in my opinion, it's not necessarily supply and demand because your supply is dependent on the cost it takes to build the house. So you can't lower the price of homes below the cost to build them. And I think that's what she's trying to imply here. She's like plain old Econ 101. No, if you could build houses cheaper, they would be selling those houses for profit right now. The problem is they can't build the supply at a cheap enough price where people can afford it. And that's a function of interest rates and the cost to build the house. Looking back, I invested heavily in my early 20s. It wasn't the flashy thing to do, but it will pay off for the rest of my life. I also invested very heavily in my 20s. But if I could go back and I could do something different, I would change my strategy that I used in my early 20s. And I wish I could link up with my future self so my future self could teach myself at an earlier age of what I know today. So that's exactly what I have on the website is I'm helping people or trying to help people learn the ropes in the markets. And if I had the knowledge I had today in my early 20s, oh my God, I would rip it up. And some people are probably saying, well, what strategies would I deploy? Well, I would choose less risky companies and I would go for the best risk reward the market has to offer. The hard part is how do you identify that without gaining experience to know where that best risk reward level is? And that is where experience comes into play. And I don't know how someone in their early 20s could necessarily get that. But that would be the name of the game. It's to find the companies, find out what I know from the thesis of this channel, the real estate cycle, what does well during what phases of that cycle, and then choosing the best risk reward companies. I would absolutely tear it up over a 20-year time frame from that time frame till today. I would tear it up, absolutely tear it up with the money that I saved if I had the knowledge I had today. God, that would be fun to do again. Global demand for gasoline surpassed this year the record high set in 2019. Before the onset of the pandemic, defying expectations of a long-term decline. So gasoline demand surpassed the record high. So here's record high in 2019. Look at the actual demand and short-term forecast. Boom, ripping it. This is their medium-term forecast, but we are going way up there for gasoline demand, and it is surpassing the 29 peak. So we've got massive demand going on right now, even above previous highs of summer demand. Again, that's crazy to me. And it says, but let's keep selling oil companies to buy more Apple. Crude down about 7 million barrels. Cushing's up a little bit. Gasoline down about 0.6, and distillates up a teeny bit. Let's go in this one. This person's worked in wealth management for 7 years and advised 453 millionaires. Here's 11 strategies these millionaires use to become wealthy. So let's use some of these strategies or see if I even use them. Don't drive your wealth. Most luxury cars lose about 60% of their value after 5 years. Millionaires don't invest in depreciating assets like luxury cars. I do not drive a luxury car. My cars are old as heck. Pay yourself first. The average millionaire saves and invests about 64% of their income. Never live bigger than your paycheck. Don't consume. Instead, use your paycheck to invest for your future. Live like an undercover millionaire today to be a millionaire tomorrow. I do that. I don't spend a lot and I pay myself first. I'll be honest, guys, I love investing. I really do. And that's where my money goes. I feel so good when I put money into investments. It is kind of, I think Warren Buffett has that too. I just feel good saving and putting it in investments and watching it grow. It's kind of cool. Avoid lifestyle creep. Never allow lifestyle creep to eat away at your wealth. As you earn more money, save more money. Okay, yeah, I do that. Grow your network. A degree is good, but your network is better. One of the greatest indicators of your future success is determined by the people who know you and trust you. So yeah, I don't know if I really well, I guess I'm building my network through YouTube and the people I talk to and interview and stuff like that. Create multiple streams of income. If you have heard the saying, don't put all your eggs in one basket, then you know that you shouldn't rely on just one income source. I do have multiple sources of income, and some of it is investment related income as well. Avoid bad debt. Getting out of debt is 20% knowledge, 80% change in habit. Change your financial habits. So I don't have any bad debt. I just have my mortgage. That's it. And I locked that in at a really good time. Build an emergency fund. 63% of Americans cannot afford a $500 emergency. That means the average American would have to resort to high interest credit card debt to pay for a surprise expense. Do your future self and save 3 to 6 months worth of living expenses. That's probably what I have is about 3 to 6 months, somewhere in that range. I could easily absorb a $500 emergency. That's not really a big deal. I could absorb probably a $5,000 emergency without too much pain at all. So yeah, I have enough cash to absorb most of anything that can be thrown at me. I've got multiple cars, so if a car were to be in an accident, no big deal. If I lost a single car, I've got health insurance, I've got car insurance, and really the max out of pocket there is your deductible. I have home insurance, and your max out of pocket is your deductible. So I don't really have anything that would take more than say like a $2,500 charge really, outside of maybe the max deductible payment for an individual in a year could be 7 grand if something bad were to happen, I think. Create healthy habits. It takes about 68 days, 66 days for a new behavior to become an automatic habit. Yeah, I mean, that's what I do. I work out 3, 4 times a week and I eat decently well. I mean, it's not totally clean, but it's decently well. Prioritize your health. 76% of millionaires exercise for at least 30 minutes a day. I do walking a lot too on my non-workout days. I walk about 30 or 45 minutes. Read more books. 85% of millionaires read books for 30 minutes or more daily. Okay. I don't really read too many books, not anymore. Use money to make money. Compound interest is the eighth wonder of the world. And the way that you can use money to make money is these big dividend payers. That's kind of like your base return almost. If you get like a 15% dividend yield or something, and then you reinvest and snowball the dividends. You also have a bunch of upside potential for the commodity price to go up, for the dividend to go up, and the stock price appreciation to go up. So I like, companies that are either doing share repurchases, where they purchase back shares to drive the stock higher, which a lot of energy companies, energy service, energy, oil and gas exploration, they're all doing that. And it's like they're all trying to help you make more money. I love it. Absolutely love it. Coming on down, we've got don't buy your dream house, buy investment properties, then get the tenants to buy it for you. Now, here's one thing that I don't view a dream house. I don't necessarily have that. I mean, I've got ideas of what would be a cool house, but I think the dream more lies in not having to do work that I don't want to do. And the house is just one of the ways to get that to happen, where you can lock in your expenses with a fixed rate mortgage. So I don't want to buy a dream house, so to speak. A dream house would be something that I'd have to build and design myself because there's nothing out there for a quote dream house. But the house I live in is perfectly fine. I have no problems with it. I think the location is fantastic. Low property taxes. I think it's a good setup for what I want to do in my life. So it's not about buying my dream home. It's about living the dream life. And a house is a part of the dream life of having your own living space away from others. It's more quiet, and stuff like that. But I don't necessarily, my dream isn't around a dream house. So I know some people probably focus their life around a cool house or something, but not me. You pay 10 to 30% in taxes every year. Taxes are the biggest expense for most people. That's why I'm writing a tax strategy ebook for individuals and business owners. The most practical strategies for $0. Can't wait to share it. As your wealth increases, you are going to stress more and more about taxes. You're going to have to figure out ways to keep the money that you make. So as your income grows from all these different, hopefully, income sources, as your dividends grow, as maybe you start a business, whatever it is, you're going to have to look at taxes because taxes are the biggest expense. I pay more in taxes in a year than my entire living cost in a year. So my costs are cheaper than the taxes that I pay. And that's saying something. That's total taxes for federal and state. In fact, my federal taxes might even be more than my total expenses in terms of what I spend to live and my mortgage and the insurances. So that is crazy to think about that my taxes are basically more than my expenses. You could also say, well, you make a good amount with dividends and all this other stuff, but taxes are you're gonna have to I have an accountant. You have to really start looking at how do you save money on taxes as you grow your wealth. It says you get rich when you prioritize long-term wealth creation over lifestyle. Yeah, definitely. Folks that went to college, do you regret it? I do not regret going to college. I um, I think I got a good value where I went. I went to Cal Poly in San Luis Obispo. I got an engineering degree, and I think it better prepared me for life. I don't do a ton of engineering anymore, but I think that an engineering degree and going through the math and the science and statistics helps you become a better problem solver, and you can break down complex problems and try to navigate the complexity of the world with large problems. You can break it down and solve it better than most other people, or you can at least think your way out of difficult situations. To everyone who started a business after working a 9 to 5, how did you know it was the right time to start a business? Um, what I'll say is I started doing YouTube and other things when my 9 to 5, I started not liking it. That occurred in 2020. That's when I started the YouTube channel in August of 2020. And that's when things started to get rolling. Um, the reason I didn't like my 9 to 5 is because I was not getting merit increases. They didn't give a merit increase for 2020 to anyone that was a salary employee. Then they started getting cheap on a lot of stuff. My boss started acting really nasty to everyone. And I didn't necessarily want to go anywhere else because most jobs that are 9 to 5 and most aerospace firms, the big companies, they're all roughly the same. So I wanted to get out of it, and that's really what I did. Is I got out of it. For right, wrong, or indifferent, that's the path that I took. This is why Rich Dad Poor Dad was such an important book for my generation. It's all in there. It says, I wish when I was 18, my parents would have told me the system is designed to take from the financially illiterate and give to those who invest in assets. That is correct. Assets protect yourself against inflation. If you're trying to work and you work paycheck to paycheck, or you're taking out loans, which is interest working against you, then the financially illiterate is literally going to give a lot of these things to those that are better prepared and more financially literate. So you want to invest in assets, you want to keep some cash on the side. Those who mess up financially are going to foreclose or go bankrupt, and you can buy those assets for cheap if they go bankrupt or foreclose from a bank. That's what occurred in 2009. I bought a condo for a very cheap price. It wasn't even 6 digits. It was foreclosed on, and I got a super good deal, and I lived there for some years before I moved to another state. So, yeah, it definitely helps being a saver and having some cash and waiting for good opportunities to buy. It's almost like physical silver is rapidly destocking. Look at the inventories of these. SGE down 73%, COMEX is down 70%, LBMA London's down 32%. And you can see the current 2023 inventory levels. We are drawing down inventory levels and running deficits in silver. Let's keep running these deficits, boys. Let's drain the inventory. The middle class is really just a poor propped up by debt. And most are 1 to 2 missed paychecks away from collapse. Yeah, don't be that. Get your finances in order. Pay down debt, get rid of it, have an emergency fund, start investing, and build the life you want to live. This is where we're at, folks. Sell everything based on a chart signal. Maybe you'll buy back in lower, but I wouldn't stand in front of this train. There's almost no supply for years. This truly is a unique point in time, an anomaly. Act accordingly, says Justin. There is, you read some books. It's about keeping your position. You don't want to lose your position. I would not lose my position based on a chart signal. So Justin, you're completely right. I'm staying invested just like you are. Ride through it, baby, if we get any slowdowns. What are the most important aspects when choosing a job? Is it wage, schedule flexibility, how much of a challenge it is, or location? Well, I think it's a combination of all of those put together. I don't think there's any more important aspect out of all of these. If you have a very inflexible schedule with long work hours, I'm not going to work there. If it's a low wage, I'm not going to work there. If it's incredibly challenging with no sort of training, that may not be a good setup. You could get frustrated. And it depends on the location. If you live in a certain city and it's greater than, maybe 20 miles from where you live, I probably won't choose it. So it's a combination of all those things. It's got to be in the right location. It should be challenging enough, but you can also learn it and have some sort of training. There should be enough schedule flexibility in there so you can work your life and the job and still be happy. And it's got to pay a wage that you are happy to work for. So I don't think any one of those is more important than the other. It's all kind of meshed up together. Parents, how much does it cost to raise a kid? Well, it's not super expensive depending on how you want to raise them. If you're going to go out and eat a bunch of meals and you're going to go out to eat, it's going to be very expensive. If you make the majority of the meals from home and they're very good, solid meals, it's going to be a lot less. And it depends how old your kids are. If they're younger, like 1, 2 years old, I don't think they're too expensive. Diapers, yeah. Some baby wipes, sure. But when kids start to grow up, they start to eat a lot. And that's where the majority of the costs come into play. And if they start to do activities, they may also cost money as well. So that's where it's hit me, is food costs. And if they start doing things, then they're going to ask for money. If you had to hold one sector for 10 years, which would it be? I would probably hold oil because I think that oil-related stocks, energy service included, those are the ones that I overweighted, and that's where I would be. Why? Because they're cash flow rich, they're cheap, and they've got the infrastructure to generate even more cash. They're buying back shares, they're shareholder friendly. Everything looks really good. So that's where I'm gonna end it, guys. That's what I've got for today. Thumb up for the content, subscribe to the channel, subscribe to the website if you like, and that's what we've got for today. So catch you later. This is Finding Value.